Are you unknowingly overpaying on your mortgage every month? Chances are that there's a high likelihood that you are paying too much for your mortgage without you knowing. I'll show you a simple way that you can check and potentially lower your interest mortgage rates, which will definitely can save you hundreds or thousands of euros or dollar per year. So let's go. Hi there, I'm Paul. I make videos to help people make smarter money decisions. If you're new to here, don't forget to subscribe for more money saving tips. Now, let's talk about LTV, loan to value ratio, a number that most people will overlook but can have a huge impact on your mortgage interest payments. So what is loan to value? Loan to value is a percentage that shows how much of your house is financed by a mortgage. It's calculated using this formula. LTV is the remaining or outstanding balance that you have with your mortgage provider divided by the current home value of your house times 100. For example, your house is currently worth 400,000 euros and you still have an outstanding debt of 280,000 euros. So your LTV would be 280,000 divided by 400,000 and then times 100. This gives you 70%. You might be wondering, why does this matter? So the lower your LTV, the lower risk you are for the bank. Because if you default, they can always sell your house for a value that is higher than your outstanding debt. So there's no risk for them. But here comes the problem. Banks don't automatically update your home value. So as a result, your risk class might be higher than what it should be. And that is costing you money because if you have a lower risk class, you should be eligible for a lower interest rate. But that doesn't happen. And if you don't do anything about it, there will be no changes. Most homeowners check their LTV when they first buy their house because they will want to determine what their monthly expenses are going to be in the future and now. So they will check that. But after that, most of the time people don't check on their LTV anymore. And the banks, they will still use the home value that you have submitted when you were buying the house. At the same time, you're receiving from the government a letter telling you that your house has gone up in value and tell you that you have to pay more property tax. But the banks, no, they still use the same value. And what does that mean for you? That means that your interest rate will not be positively impacted by the fact that you have a higher valued home. That means you could be paying higher interest rate than necessary. Here is 4 steps to easily fix this. So first, go to your mortgage provider website or portal and log in and see what your current home value is according to the bank. Number 2, compare this home value with the letter that you get from the government, assuming what the value is of your house, or compare it with an appraisal report that you can easily do online to see the difference. Number 3, if your loan to value has improved, contact the bank and see whether you can lower your interest rate. Submit the updated valuation as proof. So they might ask you to send a desk research appraisal or the letter of the government to prove that your house is more worth than what they have currently in their systems. Step 4, wait for the best letter you ever receive, telling you that your interest rate will be adapted based on a better LTV, and then you'll see what your new monthly payments will gonna be for your interest. If you don't take action, you may be leaving money on the table. With currently the cost of living crisis and the fluctuating interest rate, it's smart to take action and get the best deal for yourself. Did this help you? Let me know in the comments. And don't forget to share this with your loved ones because that might help them also save a lot of money. For more smart financial tips, please subscribe and also hit the notification bell so that you can follow for more new videos. See you in the next video. Ciao.